Good morning and welcome to the Energy Perspectives Group webinar hosted by Surge Energy. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here's Dan Steffens, who will introduce today's speaker.
Yeah, thank you everybody for joining us today, and I'm happy to have one of the companies that's been on my watch list for a long time, a Canadian-based company, Surge Energy. And our speaker today is Paul Colborne, the president and CEO of Surge Energy, and he's being joined by Jared Dukes, the CFO of Surge Energy and one of their founders. Paul Colborne has over 24 years of experience in the oil and gas industry and has been involved in leadership, executive, and director capacity with over 30 oil and gas and energy service companies. Paul has successfully grown and subsequently transitioned a number of aggressive Canadian junior oil and gas companies into sustainable, modest growth, dividend-paying companies with excellent results, including StarTech Energy Inc., Crescent Point Energy Trust, and Starpoint Energy Trust. At each of these companies, he contributed to the significant shareholder value that was created. Jared Dukes is a chartered accountant with more than 12 years of accounting and finance experience in the oil and gas industry. He is a founding member of Surge, having held several progressively senior positions with the company. Prior to being appointed the CFO, Jared held the position of Vice President of Finance. Prior to joining Surge, he was a senior associate with Ernst & Young, one of the largest accounting firms in the world. Anyway, he is a chartered professional accountant and continues to be an active member of the Institute of Chartered Accountants in Alberta. So now I will turn it over to Paul, then I'll go on mute and come back at the end of his update on Surge Energy to lead the Q&A session. If you do have a question, please type it into the chat box and we'll cover them at the end of the presentation. Okay, Paul, it's all yours now.
Great. Thank you very much for your time today. You've got Paul and Jared here, as you said. Thank you for that nice introduction. Can you make that a little bigger? Perfect. Assuming people on this can see the presentation here that we've got on the screen, there's only going to be one top company in Canada, and there's going to be several pretenders to the throne, but there'll be one top company. And I've been lucky enough in my career, as was said earlier, to do this 4 times for the top oil companies in the country with 4 different teams. And as great as I can say I am, and Jared can say he is, it all comes down, as it should, to asset quality. And that's our big secret sauce at Surge. And then the discipline to stick with elite, conventional, low-cost, low-risk assets. Now, what do they turn out? Check this quarter out. And when I say the top company, so I didn't come back to run this business. I was already on some boards and not thinking of coming back. When I came back to run Surge, I said, I want this to be the best dividending company, growth and dividending company in Canada. Well, how about this? Here's our latest quarter. What company, for people on the call here, what companies you guys follow? You're doing your due diligence. You're looking for who's the best, who's going to be the best value proposition for me. And make me the most money, give me the best dividend. Well, in any other business, I think this kind of a quarter would be pretty good. Our cash flow is up 818% over Q2 of last year in our Q2 of this year. And then I've had a lot of people say, well, yeah, but Q2 last year, that's when oil was $11. So it's up so much because the price you're comparing it to is so low. Not true. That's not true. Last year, 2 years ago is when crude hit $11 a barrel in April of 2020. Last year, crude averaged $66.50 WTI, and our cash flow is up 800% above that. Now, how about this? Banks forced all the companies in our peer group to put on really punitive hedges. We actually had a $46 million hedge loss in the quarter, and our cash flow was still up 800%. So our actual cash flow was 121, 122 million bucks, almost $500 million annualized. That's how good our quarter was. Our production was up 40%. We had a base dividend started. We hit our first debt target, so our balance sheet's really good. So we put in a juicy base dividend that's 4.7% today. And we've had a couple big exploration discoveries, which we'll walk you through. But I'm just saying, in any other sector, this quarter would be, there's our latest quarter. And if you think Q3's coming out in a couple weeks and it isn't good, you'd be wrong. It's really good. Now, how do we do this? What is Surge doing? And by the way, who's been one of the top 2 performers in the country since November? Surge. And that's because smart investors like you guys are doing your due diligence. And there's really 3 main ways I know, but on how to value an oil company. But this is the key I mentioned to you. It drives from the asset. That's our advantage, our secret sauce, if you will. Elite, conventional, low cost, low risk assets. The discipline to stick with those and not go into the sexy, deep, expensive, tight rock with huge fracks, huge costs, huge declines that don't water flood. We don't want those assets at Surge, and we're disciplined. Now, what do those elite reservoirs churn out in massive quantities? Free cash flow. So there's 2 ways I know, there's probably more, but 2 key ways to value an oil company. One is net asset value, and the other is cash flow multiple or free cash flow multiple. It's become the new mantra. Call it earnings per share is what free cash flow. Smart investors like you are like, quit telling me these hokey earning numbers. What is your free cash flow? You're a cash flow business, and we'll show you. So Surge is the best value in Canada on both those. And now that's just me saying it. Here's the #1 engineering firm in North America. I'm bragging a little bit, maybe down there you guys have DeGolliers and a few others, but Sproul is definitely one of the top engineering firms in all of Canada. They say Surge is worth $24.43 a share. I didn't say that. Jared didn't say it. The top firm in Canada said it after a 3-month evaluation. They do it every year. Doesn't include any value in there for land, for seismic, and we have 1.3 billion in tax pools, which is one of the best tax bases in the space. No value in our net asset value for any of those things. So we're trading at $9 and our NAV is 24. I think that you can see it's a really nice value proposition that our stock should trade into our NAV in a hot market, which it's going to. Second way I know is free cash flow yield. Who has the best free cash flow yield in Canada? Surge. I did not say that. The top mutual fund in Canada, 9 Point Partners, top performing energy mutual fund in Canada, evaluated all the companies and said Surge is the top. If you go to that next slide, here's the chart. So if you back out big companies way bigger than us, US companies, which are not really in our peer group of intermediate Canadian oils, and gas companies, Surge is alone in that quadrant with a little, maybe a tick of Tamarack in there. So I'm saying to you, it's ever thus. So the elite reservoirs and the elite assets turn out the best net asset value upside to a company's shares, the best drilling locations, the best payouts, and that drives the best free cash flow. Surge has both those. You guys probably know the macro well. This chart is actually outdated, I believe. It's got a few more weeks of tremendous downward plunging inventories in the US. And we're basically saving the world, we think, right now by pulling emergency barrels out of the strategic reserve. We think that has to stop in the next month or 2. They're down to the lowest level in that cavern since 1982. So we believe that crude is going to spike. We think it's caused not by the Russian invasion. It's caused by 7 years of chronic underinvestment in the most important industrial commodity in the world, what runs our entire planet. And we listened to climate change radicals that politicized it and got elected. And now we're wearing the fact that we've used up all of OPEC's excess capacity. There's no oil on the planet. We've underinvested for 7 years in a row, soon to be 8. It was wrong, and now we're wearing it in higher energy costs. And if I was a dad with a family in Europe this winter, Northern Europe, I would be scared. I believe we have a crisis on our hands, and you're seeing it already with diesel. Not just that diesel prices are at all-time highs and spiking. There's no diesel at the pumps. You're driving your diesel car up to the pump in Europe and there's no diesel there. It's going to happen with gasoline, natural gas. It's scary for me, and we didn't want this, but this is what we're looking at, we believe, this winter. What does well during inflationary times and even stagflationary times? Oil. Smart investors like you, it's the only sector on the planet that's working. Techs are getting crushed. Consumer staples are getting crushed. All these things that did well in the COVID crisis year are getting crushed. And look at Tesla this morning. They just put out some bad numbers, and their stock was down 6% yesterday. We're doing the opposite. We're delivering record production, record cash flow, and record earnings, and free cash flow, and record dividends at Surge. Here's our numbers there. Jared's going to walk you through. These are our estimates, and I want to show you that how we derive that free cash flow yield at Surge.
Yeah, you can see here some initial management estimates for next year. And the reason we're really focused on that is because, as Paul mentioned, we had some lender mandated punitive hedges that rolled off most of them already at the end of the second quarter, a few more they'll trickle out here at the balance of this year. When we really think about Surge next year, you can see that free cash flow yield that Paul talked about. We're producing 21,500 barrels a day of oil equivalent production, 86% weighted to oil and natural gas liquids. So very oil focused here at Surge. Because of the asset base that we're going to walk you through, it's a low decline conventional asset base. It only takes us $165 million of all-in capital to maintain that 21,500 barrel a day production level. But when you think about just $85 oil, a little less than we're seeing today, Surge will generate cash flow of $330 million or $4 a share next year. Well, when it only takes about half of that to maintain the capital, the other half, 50% of our cash flow, is free cash flow, another $165 million or about $2 a share, free cash flow yield to our shareholders. Well, our entire dividend right now is only about $35 million or roughly 20% of that free cash flow. It's not our cash flow. It's only about 10% of our cash flow. It's 20% of our free cash flow. So there's an incredible amount of free cash flow here in 2023 that's going to make its way into our shareholders' hands in a few different ways. One of the things we put out with our second quarter was our return of capital framework to illustrate how we're going to put that free cash flow back into the hands of our shareholders. We're in phase one right now with our net debt just above $200 million. We instituted our base dividend, as Paul said, just about a 5% yield, paid monthly in cash. But the bulk of the free cash flow right now is going to rapidly reduce debt and increase net asset value for our shareholders as we pay down debt. As we reach our phase two target in Q1, Q2 of next year, depending on commodity prices, we're going to double the amount of available capital for shareholder distributions. So that will come out in the form of increases to the base dividend, share buybacks, the potential for special or variable dividends, as well as additional debt reduction. As we reach our ultimate core debt target of $125 million in phase three, nearly all of the free cash flow will then be allocated to shareholder returns. Again, increases to base dividends, additional buybacks, special or variable dividends, as well as the potential for a production growth wedge. And that's all coming here in relatively short order because of that incredible free cash flow yield we just spoke of.
So I bragged a lot about our asset base and asset quality, and I said it's the best in Canada. So I better be able to back that up. And it's what drives our whole company, as it should. So this sounds very trite, and I'm just a corporate finance lawyer. So I've done this 4 times, built 4 of the most successful oil companies in Canada: StarTech, Crescent Point, Starpoint Energy Trust, and now Surge. And I did it with 4 different management teams. What did I learn? How did I do that? I'd love to say it's just me, but it's this simple. Elite conventional, low cost, low risk, shallow reservoirs that have low declines and water flood wildly outperform deep, expensive, tight rock with huge costs, huge fracs, big declines that don't water flood. That's it. And yet people still want to hear about the sexy you know, Duvernay plays, Montney plays, Permian plays that cost 10, 12, $15 million wells. Our wells cost $1 million in Saskatchewan, all in online. They pay out in about 8 weeks at today's prices. 8 weeks our wells pay out. Those are the kind of reservoirs that Surge has and what we want. What do they drive? Better profit to investment ratio decisions or returns, and way higher rates of return. In fact, you're going to see here in a second, there's one company in Canada, 2 big research pieces have come out. Raymond James put out one study. Peters and Company just put out their own. There's one company in Canada that has dominant operational positions in 2 of the top 4 oil plays in all of Canada, Surge. And it drives all of our financial success is driven by asset quality, as it should be. But if we don't have that, then the building block on the ground is not there. Well, ours is the best plays in Canada. So of course, it's going to drive that huge free cash flow yield. Now Jared's going to show you. So that sounds good. Good for you, Paul. You're saying your rock is go back one slide. So along the bottom is, I'm just a lawyer, so I had to learn this. And then we created this slide for business people. Tightness of rock is on the left, permeability, 0.1 millidarcy and tighter, deeper, more expensive rock on the left. And on the right is Surge, the low cost, best, highest quality perm rock, 0.1 millidarcy and better. That's what we have. So Jared, on the next slide, is going to show you this. What does it mean for you and me and investors on this? Why is Surge able to do this? We'll show you. And that's, we tried to create an empirical example is what Jared's going to show you, what it means to you.
Yeah, so right now we talked about that $24 per share net asset value as independently identified by Sproul. Inside of that, we've only cummed or recovered to date 6.4% of the 2.7 billion barrels of original oil in place that is under Surge's control under our lands net to Surge. So when you think of that $24 net asset value, we've only booked about 450 additional drilling locations and a total booked recovery factor of 9.6%, as you can see along the bottom row. What does that mean? Well, these are the conventional reservoirs that Paul spoke of a moment ago. On primary recovery, without secondary or tertiary recovery, we see recovery factors up to upwards of 20% in some of these reservoirs on primary. Then we go in and water flood these reservoirs and see 20, 30+% recovery on water flood. And yet we're only booked at 9.6%. So what if we change that recovery by 1%? We go and recover 7.4% instead of the 6.4% to date, or we book to 10.6 instead of 9.6. Well, we booked 27 million more barrels. We apply a conservative $40 a barrel net back, talking about over $1 billion of undiscounted value to our shareholders from just a 1% change in that recovery factor. Our whole market cap here in Canadian dollars is about $800 million today, for context. So more than our entire market cap worth of value for a 1% change in undiscounted cash flows. And that really speaks to why Surge is so focused on these large oil in place, big conventional reservoirs, because small percentage changes in recovery factor drive outsized returns for our shareholders.
So what we'll show you quickly is just our 2 main properties. It turns out they're 2 of the top 4 plays in the country, as independently ranked by Raymond James and Peters and Company. And that's our Sparky and Southeast Saskatchewan plays. 70% by the year end, it's going to be more than 65. It's at like 72% of our production by year end will be in those 2 top plays, and about 85% of our capital goes there. Now, here's the ranking. Jared, do you want to walk them through this?
Yeah, Paul referenced this on the right. We've got a really great chart by Raymond James where they came out and said, all right, how quickly do these wells not only pay out, meaning give you all your drilling capital back, how quickly do they give you 100% profit, twice your money back, effectively, 2 times payout? Well, proud to say Surge has dominant positions in 2 of those top 4 plays. It's the Clearwater that you might have heard of. It's our Southeast Saskatchewan conventional. It's our Sparky, and then it's the Charlie Lake play in Northern Alberta. Well, Surge not only has, as Paul said, upwards of 70% of our production in these 2 areas, 2/3 of our over 950 drilling locations are in these areas. So we've got a decade plus of drilling in 2 of the top plays in Canada. So it really speaks to that dominant operational position.
I'm going to take the Sparky here. This play, I'll admit, has turned out better than I thought. This is a 11 billion barrel play trend, conventional. It was drilled vertically, and really all it is nobody brought modern technology to it. So we thought it was all heavy oil. 7-8 years ago, we discovered that 4 billion barrels of the 11 billion barrel trend in the Sparky is in the light and medium gravity windows, so 20 API and higher. So we went, wow, that's good. We went in there and we started at 1,000 barrels a day. 8 years later, this 2 weeks ago, we crossed over to our first week of all time in corporate history, over 10,000 barrels a day. So we've grown it from 1,200 to 10,000 barrels in 7.5 years. We drilled 200 good wells in a row. We have 450 more locations there, and we're the dominant player in the medium and light gravity window of the Sparky. So here's the Raymond James payout. We now control of that 4 billion barrels in the medium and light window, almost 1 billion barrels of it. Surge, we own it, we control it. We have almost no competition. Some of the plays you'll see, like your Permian play you guys have, and Eagle Ferdinand, or up here, the Clearwater, massive competition for lands and that kind of thing. So on one of the proven play trends in Alberta history, all drilled vertically, all we did is bring horizontal Packers Plus technology to it. And so far, we have no big competition yet, and we're gathering all this prospective acreage and oil in place, frankly, off these old vertical well logs, and just applying modern technology to it. So we're having a great time on this play. We've grown it dramatically. This chart is great. I love it. It's Ray J's chart. But it only talks about well payouts. So we're ranked, it's the 4th best play out of 90 plays they looked at in Canada. The Sparky's number 4. Great. As Jared said, it's based on well payout. It doesn't include water flood. So we book 125,000 barrels on primary before water flood. Just drill it, produce it out. It's great. It's 4th ranked play. If you add water flood in, when we flood our Sparky wells, we book 400,000 barrels for a Sparky water flooded well. It becomes a payout ratio, profit to investment ratio of probably 8, 9, 10 times your money back, undiscounted over time. We think it clearly vaults the Sparky to the top play in the country on a full cycle basis. And the beauty is, this chart's out of whack here now. We just went over 10,000 barrels. It's quite exciting because we have no competition of any meaningful size in that medium and light window. We think we can keep growing this thing to 15 or 20,000 barrels. We have over 400 locations a year, or for drilling, we drill about 40 a year. So a nice 10, 12-year inventory. So exciting play and ranked very highly in all of Canada.
Yeah, the second play we want to walk through briefly here as we get towards the end of the presentation is our recent re-entry into Southeast Saskatchewan. This is an area where Surge has had prior success in the past, selling previous assets here for profit in 2015. Paul, as well as our senior VP of Geosciences, Derek Christie, have had a fabulous 20 to 30-year track record in this area, driving value. So we really focused on getting back into Southeast Saskatchewan over the COVID period. And pleased to say we got back in here late last year with 2 strategic corporate acquisitions. So why are we targeting Southeast Saskatchewan? These are some of the quickest turnaround wells. They go from spud to on production in under 2 weeks. As Paul said, conventional reservoirs. The porosity and permeability is so good here that we're not fracking. So these wells are about $1.15 million to drill, all in, drill, complete, equip, and tie in. And we see lots of opportunity here for organic growth that I'll talk about in a moment. Additionally, this is some of the best netbacks, top decile netbacks across Canada for 50 to 75 years. Some of the best operating netbacks in Canada, in North America, frankly, have been in Southeast Saskatchewan. And so that's driving, as Paul said, wells right now that we're drilling in our Steelman area, for example, in Southeast Saskatchewan, are paying out, giving us all of our drilling capital back in 8 weeks. So fabulous payouts. And we've got real running room here, over 250 million barrels of original oil in place under our lands, about 250 drilling locations here, driving an 8 to 9 year inventory of wells, as I've just spoke of, with incredible payouts. well over 5,000 barrels a day here of production. And, to speak to the organic opportunities here, we announced a couple months ago an organic land sale in Steelman, where we acquired over 45 net drilling locations. Some of the wells there have been significantly above type curve. A type curve here is 175 barrel a day. See wells coming on at 400 barrels a day plus. So fabulous results, and there's really room here to grow and acquire. I think before I turn it over to Paul for some closing comments, would like to reiterate Surge's strong commitment to the ESG principles as it relates to the environment. Really focused on reducing the environmental footprint of our operations, taking some of the inactive wells, 260 of them last year, and abandoning them, returning them to a natural state. So really focused on reducing the footprint of inactive wells, as well as conserving and reducing emissions. A good example in Southwest Saskatchewan is a gas pipeline we put in place, conserving over 70% of our Scope 1 emissions in the area, and also allowing us to tie in and sell that gas. So it's a really economic project that reduces emissions. So those are the kinds of win-win ESG projects that we look for here at Surge. From a governance and a social perspective, we have a board that's 33% female and a workforce here that's over 50% female. So a real focus on diversity here at Surge as well.
I guess to close up, I'd like to say, don't take my word. Don't take Jared's word. There's 11 of the top analysts in Canada, and all of them have targets on Surge that are our average targets, probably around $14, $15 a share. Our net asset value is 24, best free cash flow yield, highest asset quality, and a nice juicy dividend on a really, really low payout ratio. So if you think I'm not intense, I've done this before. I did not come back to run an oil company. I've already done that successfully with StarTech, Crescent Point, Starpoint Energy Trust, and now Surge. I want to be the top performer. It gets me up in the morning. Now, we're going to have one of the biggest conferences in Calgary history on Saturday, and there's some other good CEOs there. I'm just letting you know. It's so exciting for me because I have there's 10 or 11 of the top analysts in Canada, and I think Alberta Treasury Branch is coming out as well, the big buy on us. Our goal is to be the top performer in the country. I'm accepting nothing less than that of myself, of Jared, of our team. We're really driven, and it should be driven, as I've shown you. The financial results are driven by the asset quality. It's ever thus, as it should be. So we're quite excited. Look for us to be the top performer, and I want to have this presentation maybe every 6 months or every year. But by this time next year, please hold me accountable. I expect Surge to be the #1 performer in the country because of our asset quality and our drilling locations and the elite oil pools we have. That's our goal. Now, let me ask you this. Who's the top performer in the country since November of last year? Surge Energy. There's another company called Obsidian and Cardinal. So when you stack us up, there's not that many good smaller intermediates that can grow in Canada now. And I believe Surge is going to rank #1, and that is our goal. And that's been my track record in the past. I think this group is based out of Houston. So I'll give you a quick analogy. I played football quarterback for University of Calgary in university. So I'll give you a football analogy. You've seen the Cowboys fall onto some really rough times. Think of me back as I'm the intensity of Jimmy Johnson. Jerry Jones, stay in the owner's box. Jimmy Johnson, I got guys like Jared, that's my Emmett Smith and Troy Aikmans and whatever. We've got that intensity. We want to go and put a couple big Super Bowls on the board. And I've done that in my career. Been the top performer in the country 1 year at Crescent Point. So to give that analogy, that's the kind of intensity we wake up with every morning. And we want to be the top performer for people like yourselves. And I really, really like getting the dividend back. So you got a dividend yield. Just do the math with me. Do the math. It's a 5% yield, just under, on, as Jared said, just 10% of our cash flow, only 20% of our free cash flow. We could jack the dividend 2 or 3 times, like 100% higher. We wouldn't do that initially, but if you think we're not going to push those shareholder returns, those free cash flow out to our shareholders, you're crazy. And that's how we end up with one of the best free cash flow yields in Canada. So it's really exciting time for us. We're marketing like hell this fall. We waited through kind of the doldrum, crappy summer, and now you see crude starting to spike again. Our stock went from 372 in November to 1368 by June. Then the whole market rolled over, went for a rollover, and now crude's back up to 88 bucks. I think it hit this morning, and our stock's starting to rise again. We will trade up to at least our net asset value. That's at 80 flat pricing is our $24 now. Well, how great is that? And you get a juicy dividend on a low payout ratio while you're waiting for a surge to trade to its NAV. So from an investor standpoint, we really appreciate your time today. Look for us and hold us accountable. By this time next year, I want to have this call next year. Jess, if you can set it up for us and let all of you know where we stand. And our gut call would be, we're going to stand out as number one in the country. So any questions you guys would have for Jared or myself?
Yeah, okay, I'll get into the Q&A, but I wanted to say I love your way to value companies. I think a lot of the Wall Street gang, they use net asset value, just kind of net asset value, and I think that's one way. But my background I was with Hess for 18 years, and I had business development there, and we were looking for takeover targets constantly. And to get on our list, it was 6 times cash flow. And, now you got these high quality companies trading for, 3 times cash flow or 2 times cash flow. Some of them, it's really amazing. And I want to agree with your comments. I think what we're going to see out of Europe this winter is going to open everyone's eyes to the importance of fossil fuels again. We just went, hook, line, and sinker on these Green New Deal projects, and they are all going to disappoint on the amount of energy that they are provide. I don't think they're going to dent the demand for oil-based products at all. I think because demand for energy is growing so fast. We need them. We need an all of the above energy policy, but boy, we're going to need oil and gas for a long time. And I think you're going to see a lot of investment money move back into this sector again. So with that, I will get into some of these questions, but you touched on it really, your slides 5, we could go back to that for a minute, is, this your net asset value of just your P1 reserves. I was looking at your reserve report is $15 or $16 a share, Canadian. I think that's Canadian dollars, right?
Correct. Yeah.
Yeah. Okay. In Canadian dollars. And then you go the P2 reserves, which is proved plus possible, probable. And probable reserves in these plays that a lot about are really, they're very close to P1 reserves already. You just have to go out and drill in those areas. But why don't you, if you could talk a bit about how proved reserves they're defined a little bit differently in Canada than they are in the US, and then how they come up with the oil and gas prices that they use in their valuation.
So Dan, I think that was you speaking, right?
Yeah, that's me.
So for the people on this call, Dan just said, in my opinion, one of the smartest things I've heard from an investor or an analyst in a long time. And what he's trying to say is, on a conventional company like Surge, the risk on our probables is almost zero. It's valued. The PDP and total proved cases are risked above 90%. PDP is what is a lead pipe cinch there. Total proved is over 90% certain. And P plus P is just under 90. And they've tightened that category to make it. But then layer in that chart, go back to the chart on your chart about the 1% of NAV. So then you look at this chart, because this is conventional, what you just said, Dan, is brilliant, because the risk on us getting to the P plus P case, as Jared said to you, is almost zero.
Right.
Look for us to get to 20%. 30, I believe, is very attainable on water flood and that, but just 20%. Well, as Jared said, each percentage point is about $1 billion on a $40 net back. We're getting about 65 today, but assume a lower oil price. that's our entire market cap is equal to a 1% change. And because we're a conservative, shallow, low-cost, conventional reservoir company, there's not a lot of risk in our asset base. If you're in a deep, tight play, there's a ton of risk. Where do the declines end up? The costs are $12, $15 million a well. The rock is tombstone. You have massive fracks at a huge cost. You're trying to create permeability by creating rubble with the frack on a massive frack. Then it has steep declines and it doesn't water flood. So where will the wells level out? There's so much risk in a unconventional asset base. And go back that one slide. And this is for investors. And I'm just a lawyer by trade. I had to learn this the hard way. I don't want, as Dan said, you're not getting with Surge the risk associated with the extremely tight or very tight or even tight rock. You're getting the low cost, shallow, conventional elite reservoirs that bought the US majors up to Canada. It brought them up in the 40s in the Shaunavon, the Sparky, Southeast Sask, 40s and 50s when oil's $3. Our plays worked in the 50s when oil's $3. You can imagine how lucrative they are today at $85, $88 US a barrel. So it's a brilliant point, Dan, you have. So when you see our NAV at $24 and then you risk adjust it for the type of play, he's bang on. Like we will trade to $24 NAV in a market like we're starting to see now.
How do they, for Canadian proved reserve valuations, how do they determine the oil and gas price used in the calculation? I know in the US,
$24 relates to a flat $80 price file. So all we've done is taken the independent engineering report and applied a flat US $80 WTI price to that, is how we come to that. When you see on the far left there, the Sproul number at year end, they effectively take strip and run that out on their numbers.
But they're looking forward, not back. Like in the US, they look backwards.
Oh, correct. Yes. No, in Canada, it's forward looking.
Yeah. And I will tell you, a lot of these companies, because, when they did their 12/31/21 reserve reports, those were based on very low oil and especially very low natural gas prices. So all these companies, when they report, 12/31/22 reserve values, they're going to be much, much higher. There's going to be a lot of companies trading below net asset value based on that. And I think that's going to draw a lot of money into the sector. I think that'll make a lot of more fund managers feel comfortable about these valuations. And plus they've done a great job of cleaning up their balance sheet. Speaking of that, where do you guys stand on your debt? Do you have a slide on your debt, or just what do you got? Is it all?
Yeah, we have one of the best balance sheets in the peer group in Canada. And with that much free cash flow, our whole dividend's about 35 million. So we're putting about 130 million on our debt, but our debt to cash flow is already like 0.7, 0.8 times today. By the end of the year, it's like 0.6. By January, February, we have zero bank debt. So our debt is about 250 exit the year, just under.
Yeah, exactly. We reported 280 million of net debt at Q2, and as Paul said, expect significant reduction in that out of free cash over the balance of the year. So based on current pricing, we'd say late Q1, early Q2 to see that sub 200 million net debt. I think as a Canadian producer, it's important folks understand that the great majority of our debt is term debt, which isn't normal for a company of our size. Most of it would be on a revolving or reserve-based lending facility that's determined every 6 months. We've got stable 5-year term debt underpinning about 160 million of that net debt. So as Paul said, very shortly, we're going to have all of the RBL, first lien term debt, paid off and just have stable term debt underpinning our model, which allows us to generate incremental free cash to send to our shareholders.
And when does that due?
That is not due until the end of 25.
Oh, okay. So you don't have any near-term debt problems. End
of 26. Apologies, end of 26.
Yeah, one of my key valuation metrics is running. I call it running room. That in your current leasehold, you have what, 500 or 600 development drilling locations?
Got 950 drilling locations, only 450 of them booked.
Yeah, and see, I don't think the market's giving any value to those drilling locations. I mean, you could go sell those right now to somebody, probably, right?
Yeah, so we think it's about 300, less than 300 booked in the total proof case, and 456 are booked in the $24 net asset value case. So not even half our locations are booked. But you touched on with your first comment was our locations are all good. Their tier ones are the best in the country,
Right.
on that ranking. And our tier twos are right there, close to that. Even our tier threes are really good. So we agree with you, is I don't think the market is making the distinguishing thing that you did at the get-go, going the NAV of Surge is a really low risk NAV, the $24 NAV. So yeah, I think you're bang on.
Yeah, I just can't believe that there's somebody in rolling these companies up. They're, you know, you could buy these companies that hedge it in that they pay out in like 3 years.
Yeah, and when you were at Hess, John Hess is a brilliant guy, and you said you guys, the market back then was 6 times. Well, Surge is going to cash flow over $4 a share, and we're trading at 9. So call us 2.25 times cash flow, free cash flow yield. We're trading at, another way of saying it is we're trading at just over 4 times free cash flow yield. 4 times free cash flow. It's crazy.
I know.
There's another chart that Nuttall has,
crazy.
Eric Nuttall of Vegas, and that is Surge. It may be in this package or not, but Surge, yeah, there it is. This, who's the second? In our peer group of the smaller intermediates, the nice size companies that can really grow, like billion-dollar companies. We're number 1 in Canada. There's some big companies there and some gas guys. We're number 1 in Canada of the oily companies in our group that could pay back all their debt and buy back all their shares in, what is it, 2.8 years. That study at the bottom goes to your point, Dan, that
Yeah,
oh my God,
and your reserves are long live reserves.
yeah,
It's not like you have these high decline rate shale wells that if you stop drilling, your production is going to go down rapidly. So you have to keep drilling just to hold production flat. Like
yes.
crazy.
So we have, to Jared's good point he made, go to our numbers estimates for the year. So this is really the key is we're going to cash flow, let's say 85. Oil's hit 88 today, but it's a nice proxy. So 330 million next year. It only takes, because we have a low decline. We have a 25% decline, one of the lower in our peer group, not a 45% tight rock decline like Dan said.
Yeah.
Well, that means we only need 165 million to stay flat. So our dividend at Surge is 35 million. That's the 5% yield. So that leaves 130 million of excess cash to pay down debt, increase the dividend, add a growth wedge, special dividends, like share buybacks, all of the above. And we're just doing ours in a phased in approach. And that's why you saw our base dividend as we hit sometime in April, end of April, our next debt target. Then we're going to push out a dividend increase, start our share buyback program, and then we'll just continue to phase it in over time as we keep paying the debt down.
Yeah. The only risk that I see for you guys is if there'd be a big crash in the oil price or something. And I don't see that happening. I agree. I will tell you my theory on oil prices. And I was on a conference call that Dan Dicker, he's a real sharp energy guy. And he's saying oil could go to 120 early next year. I think when this noise, and I just call it noise of Team Biden draining our strategic petroleum reserve, which in my opinion is a huge national security risk. Once that stops, I think that noise gets out of the way. And if we can just get past a little bit of the fear of recession, I think you're going to see triple digit oil prices quickly. The strip is not a forecast. I like to remind people that it's a derivative, just with risk adjusted. The real forecasts are going to, the real oil price is going to be determined by supply and demand. We're going to find real quickly this world is undersupplied by a significant amount when we get into this winter, especially. But yeah, it's great. On just to get to a couple of questions. Okay, what in Canadian dollars now? If we're at $87 this morning on WTI, what do you get in Canadian dollars? How does that equate to per barrel?
Yeah, so on a Canadian dollar basis, you're touching about $120 Canadian WTI. Now, of course, we have different crude streams. We have
Right.
the Sparky, which is more of a medium crude, and then we've got the Southeast Saskatchewan business unit that's a nice light sweet. So the stuff in Saskatchewan is going to be getting about 115 Canadian at the wellhead right now.
Wow. That's
Yeah.
good.
So that's, yeah, exactly. And then, we have seen with the SPR release a little bit of a widening in the light and medium, the medium differential that affects the Sparky, but on a normalized basis with about a $15 differential there, we'd be sitting around $95 today Canadian. So obviously we're working through a little bit of the widening there, but we do have some hedges on for that differential, price differential for the Canadian mediums that are protecting some of that.
Okay, and let's talk about your hedges for a minute. A lot of your swaps have fallen off, so you got collars on for 2023.
That's right, exactly. Those lender mandated forced fixed price swaps are by and large behind us, a few more to trail off. But really, when you look at what we're doing going forward, if you take a look at our public disclosure on our 2023 hedge book, it's really all about collars, setting a firm floor at 65 US WTI, protects dividend, protects the capital program. But in some cases, for instance, Q3 of next year, our hedge book there averages about $145 US WTI ceiling. We're targeting about 30%, 30 to 35% of our net production hedged, but a real focus on protecting the downside and participating. And you see that in those extra wide collars.
Okay, that's good. You talk about the water floods. Are you looking at any other enhanced oil recovery methods like polymer flood or something like that?
Yeah, not so much polymer flood, but we've come up with a unique drilling solution for the slightly heavier Sparky barrels where we're not drilling the single leg horizontal and then fracking it. We're drilling 6-leg open hole wells for like 19 and 20 API reservoirs. We don't really have any heavy oil like 12, 14, 16 API, but so yeah, in the Sparky, we're that would be kind of our sexy play is, geez, we're drilling 6-leg open hole wells for $1.5 million.
Really? Well, you don't have to case these. You don't have to case.
No, you don't have to case them. They're just open hole, and
really,
we're using kind of the Clearwater technology, which is further north, and brought it down here for the kind of slightly heavier oil, and it's working like a damn. So it's been a nice tool in the toolkit for us to go after the slightly heavier Sparky.
Yeah, and as it relates to your question, I think what the nice thing about Surge is, we're just starting to get through the primary recovery. We're water flooding with great results, for instance, some of the Sparky. So we're really just starting that secondary recovery. So that concept of going to tertiary, like a polymer flood and stuff, that'll be way down the line. We're pretty early in many of these reservoirs' life cycle, which means there's a lot of oil to get out of the ground with primary and then water flood before we, really consider some tertiary.
Okay, and somebody put in this may go with this is do you have any transportation issues or you have any trouble getting your production to market?
No, that's a great thing about where our assets are located. Southeast Saskatchewan, obviously is Saskatchewan, it's downstream of much of the apportionment or pipeline constraints that once existed, particularly in Alberta. So there's no issues there. Quietly, there's been a lot of pipeline capacity added through things like drag reducing agents on the main line. The line 3 replacement has been great. So there's really no pipeline capacity issues up here in Canada. And even when there was back years ago, Surge never had any problems because we operate in areas like the Sparky in central Alberta. We can truck our crude and move it around and get the best price for it and ensure it gets to market.
Okay, good. Let's see. Somebody asked, how does the recent strengthening of the US dollar impact your stock performance?
I think there's, again, I could do a analysis of the tie. I think crude was 128 in May, June, and it dropped to as low as 76 here recently. And our stock, like everybody's dropped, 40, 50%. Now crude's rallied back to hit it. I think it went over 88 this morning, up again. And I agree with you. I think we're back in triple digit before the end of this winter. You're in good company, by the way, Dan, because you saw JP Morgan reiterate their $150 number, and you saw Goldman come out with over 100 as a target for next year. So I do think our like a lot of oil companies, our stock price is tied to the price of oil for investors. But I'm just letting you know, because of our conventional, low cost, low risk asset base and our low drilling, surge looks ridiculous at 60 WTI, especially with the dollar where it is, the Canadian dollar where it is.
Yeah.
At 85, which we're seeing 88 this morning. And then you look at the Canadian dollar equivalent of it. We're literally, our biggest issues as a management team are how to push the cash out to shareholders. And one little twist for you and for US people, we have 1.3 billion of tax pools. There's some of our peers are paying 70 and $100 million of tax already. Surge, we have 1.3 billion in tax pools, and it provides about a 4-year, 5-year tax horizon where we can push, keep the money away from the government and push it out to shareholders for the foreseeable future. It's a huge upside that doesn't really get quantified very often on calls like this, but it's a big benefit for a dividending company like us.
It's a big thing for me because I'm a tax guy. I worked in the tax department at Arthur Anderson before I got into this, and I was actually tax manager for Hess, based in Tulsa for a while.
That's too bad, Dan. I'm really sorry to hear that. You're a tax accountant. Holy Dinah.
I was actually in Tulsa. I was like one of the top windfall profit tax experts. I battled with the IRS for 6 years in a tax court.
Oh, wow.
It was something else. You want to pull your hair out, deal with the IRS for 6 years in a row, man.
So I'm getting a picture of pocket protector and your strap and your computer strapped to your belt, and I'm hoping that's not the case anymore.
No, not me. But I would tell you,
I'm just a lawyer by trade, so I'm throwing rocks at a glass house here.
Well, we are, because of our size, we had offices in our office for the IRS, a couple offices where there are agents in there all the time. And I would walk back there occasionally, and the audit manager that was handling the windfall profit tax audit, I found him asleep in his office several times. It was like insanity, man. But anyway, what are you looking at for M&A opportunities where you are? Are you getting on more acquisitions, bolting on more acreage?
Yeah, but don't in our world,
you don't really need any right now.
Yeah, I don't want you to think in terms of acreage. I want you to think of, are you bolting on other elite reservoirs that meet your criteria? And we're not a conventional is wrong to say it. We're not a resource play that is a ubiquitous chunk of land that's
right.
That's sitting there. So we are reservoir specific. We look and target big oil in place, high quality, actual discrete reservoirs, and then we go after them. And when we do our evaluation, it's that secret sauce. If you go back to the secret sauce slide, we do rigorous work to find, keep going back actually, because remember right to first slide, it drives our entire company. This is our secret sauce. We're targeting those discrete, elite, large oil in place reservoirs where we can infill, step out, water flood, horizontal, Packers Plus, add more barrels through disciplined capital spending. So yes, we're always looking at other reservoirs. And the funniest thing is, it's like, again, I'm sorry to keep drawing a football analogy, but it's like you target an offensive lineman that you need to complete your O-line so you can make a run at the Super Bowl. Sometimes it takes you a year, 2 years to get that guy, and then you get him and he fits in like a dream or a running back or a receiver. So we target those elite reservoirs and then we go after them. I had one time, 4 companies later, I targeted a pool called Wainwright in our Sparky area, and it took 17 years, and I was in my 4th company and we landed it. And it's an elite reservoir and it's been flat for 7 years since we bought it. We've never drilled a well there. And that's what you get when you can get your hands on these elite reservoirs.
Yeah. You got everything that I was looking for when our team at Hess, where we could buy companies that had, solid cash flow generation right now, but also had a lot of running room, had a lot of high quality acreage tied up. That's what we were really looking for. And, it's like you're getting it for free almost. If you buy them at a percentage of their cash flow, you get all that upside for free. What's your royalty rate up there?
Yeah, great question. So right now we're sitting around an 18% royalty rate here on average corporately.
Okay. And do you get any discount for like new wells and stuff?
Yeah, for sure. So new wells, depending on the province, et cetera, you can get about 2.5% to 5% royalty breaks during, say, the first 35,000 barrels in certain provinces. So
Yeah.
for sure, we do get royalty breaks. So those are included in that number. So older wells would be at a higher rate, new wells would be at that lower rate, and the average is 18.
Yeah, and for some of our new members that are on this call, in the United States, companies they report their production revenues net of the royalties. In Canada, they report gross, and then as a deduction to that, the Canadian royalty is right under that. Where in the U.S., royalty rates are running like close to 25% of they're under 20%, maybe 15, 18%. They just show it differently on their financial statements, and I do on the models as well. So,
so for a new well in Saskatchewan, we get the first 35,000 barrels royalty free. So,
oh, great.
I'm
That's
not
awesome.
quite sure how Jared said that. It's all in our numbers, but I'm saying it incentivizes you. That's why we get those ridiculously quick payouts, like 7, 8
Right.
weeks, 10 weeks on a well payout, because the rates are so good. And then there's a royalty free period where you're getting cash flow like crazy to pay the well out initially. So it incentivizes drillers to companies to drill wells.
Yeah. Well, it's a good system. I wish we had some of that down here, but what are they talking about up in Canada? I know, first of all, for people too, Western Canada is very friendly to the oil and gas industry, and Eastern Canada is like our government seem to want to put an end to it or something. So are they talking about it in Quebec? What are they talking about? Your fearless leader up there, what's he talking about? Potential windfall profit tax or something like that?
Well, they've already put tax there. When you start looking at the amount of tax we pay through royalties and corporate tax, it's massive. Then they've added the another tax on us here. What's the tax? Yeah, the carbon tax. So they've already pounded it on us, and all of these numbers we're showing you are net of that. So
Right.
yeah, they'll be looking like Britain did at a special tax, I'm sure, on profitability, but that's so socialist.
It is.
You know,
It is.
yeah, it's ridiculous. But we love this call because we view Texas as very much like Alberta is. We're agriculture, we're ranching, we have beef, we have oil and gas. Texas is much the same. And I think we have an entrepreneurial side to us in Alberta here, where we don't really like the government in the east, and we deal north-south a lot. We send a lot of our oil goes south to the Gulf Coast and supplies the refineries down there, ultimately through the pipe. So we love this call, and we love the fact that we've got 40 investors on the line to let you know that I think we're very similar to a lot of your independents down there, like the Continentals and the EOGs and the others. We're thrilled. But do me this one favor, Dan, and everybody listening, hold Jared and I accountable. I'm really intense, and if you think I've done this before, I'll give you an example. Crescent Point, my second company. First company is called StarTech. Built it up, sold it to the Arc Energy Trust for over $500 million. Crescent Point, I'm the founder, president, CEO, chairman of the board. The stock went from 50 cents to $48, and we dividended out another $45 during my time there. And we grew it to 180,000 barrels a day. I was been off the board for the last 7 years. All I'm saying is, I feel this kind of run in Surge. I don't think we had as good an asset base at Crescent Point as we do at Surge. And as Dan said, you can buy Surge for 2 times cash flow.
Yeah, it's crazy.
A third our NAV, or 40% of our NAV. That's on an 80 flat price deck, and I love it. And we're just starting to trade up to our NAV. So for an investor, a year from now, when our stock's $22 or something, I'll tell you how good we are, and we're still worth $24, or by then our NAV will have increased probably. But today it's like picking cherries. It's so exciting, and it's still, I think, Dan, isn't it buy low, sell high?
Yeah, yeah.
And you now get a dividend, guys, a 5% yield on a low payout ratio while you wait. It's the classic perfect moment, in my opinion, to buy, the Surges, the Whitecaps, the other good companies. It's that you'll do all your work and you're only going to see a couple good companies in our peer group in Canada. So we're really excited actually about our positioning, and frankly, operationally, the last few weeks we've been knocking it out of the park. We're above our exit rate for the year with another 15 wells to bring on production. So we're kind of pinching ourselves here operationally. Our drilling's going really well.
Where do you think your production? What's your guidance for an exit rate this year?
Guidance is 21,500 BOEs a day. 2 weeks ago, our production peaked out at 22,863 barrels with 15 more wells to bring on.
Okay.
And we're like literally some new big wells in Saskatchewan. We're turning them down because we don't need to really come in massively above estimates. So we're already through our exit rate, and it's mid October. How's that?
Yeah. How many rigs are you running now?
We're running a record 4 rigs at Surge right now. First time in history. Darren just came in and told me we've never had 4 rigs going at one time, and two in the Southeast Sask, Williston Basin area, 1 in the Sparky, and where's the other? Oh, the other one is in is it Manitoba? Yeah.
Okay. Are you going to keep them 4 rigs running?
No, what our plan is to go load level, basically 1 rig full year in the Sparky, another rig full year in Southeast Sask, like all year long, and then pick up a rig to drill in a couple out of their areas as needed.
Okay. Do you have for long term, is there a production target? Like you'd like to increase production by 10% a year or anything like that?
Yeah, so our goal will be ultimately to be hit our debt targets here, which the second one is probably April of next year. So that's only 5-6 months away. Then we'll look to bump the base dividend, put in the share buyback program, and then probably later in the year look to add a growth wedge, probably into 2024. And again, our goal, you've seen companies blow up when they try and have a big dividend and grow too much.
Yeah.
So just like you're seeing all the big US Permian flyboy companies go to modest growth, 5%, a Pioneer, a Continental, you'll look for Surge to have a 3.5, 4, 5% production per share growth and have a nice dividend. We have one of the lowest declines at 25%, and we want to keep it there. And if you add more growth, as you well know, Dan, it takes your corporate decline up.
Yeah.
So you want to manage that and keep it very sustainable in the dividend model.
And it is all your acreage held by production, or the vast percentage of it?
Exactly. Because we're conventional, there's no big offset drilling obligations or whatever. Almost all of our acreage in those locations is held by production.
Yeah. Are you seeing any supply chain problems? Because I just recently, some of our model portfolio companies have announced supply, they can't get enough tubulars to complete their wells. So
yeah, no, good question. So we have seen some price increase, the inflation. We saw a slight increase to our estimates on pricing, but pleased to say no real supply issues that have stymied our drilling. And it speaks to our earlier conversation here, where many of these wells are open holes, so we have little or no steel in them. We have seen, frac crews be another pinch point up here in Canada. Again, many of our areas, Southeast Sask and the open hole Sparky are not fracked. So, Surge has really been insulated because of our conventional reservoirs from real true supply chain challenges that stop drilling.
Yeah. That raises a point. I tell you down here, Biden, they don't understand the damage that was done to the oil field services during that COVID period. I mean, they lost a lot of good people. They idled a lot of equipment. It's just, and then they got these supply chain problems. He's pounding the table that our oil companies need to ramp up production. Well, it's not that easy as just going out and turning some valves. It's a big business, and they don't have a clue what they're talking about down here. So it's crazy. So, let's see. I think you already talked about the benefit of the weak Canadian dollar. So you're getting a much higher price in Canadian dollars for your oil. I think we
Yeah,
covered
and
that.
it's something we haven't seen before here. You know, last time oil was say triple digits like last spring here, Canadian dollar was at par or stronger than the US dollar. So we're seeing a real cushioning effect, supportive effect from the really low Canadian dollar at about 72, 73 cents.
Hey, what's your interest rate on that term debt?
Sure, it's 8 and 7/8%. So
8 and 7/8.
8.25.
Okay. Let's see. I think we pretty much covered everything. We need to get you guys down here to Houston, host a luncheon for us sometime. Hemisphere's
up,
been
Dan.
down. Yeah,
We will
Hemisphere's
be
been down here
there.
in
If
play.
you set it up, we would
Yeah.
love to come down and present to a crowd there. And do me this favor, as I said, hold us accountable.
Yeah.
Look for at least one juicy dividend increase over the next year, probably two. Look for us to put our share buyback. The key for us is we're still going to pay the dividend now, pay our debt down, which increases the net asset value, and put it in as an orderly basis on that phase program Jared said. But if we have the best free cash flow yield in the country, our goal is push all those returns out to shareholders over the next 2-3 years on a tax efficient basis.
That's great. Hey, when are you guys going to release third quarter results?
Third quarter results are coming on November 2nd.
Oh, okay, good. Early.
So
It looks pretty
Okay.
juicy too, I can tell you that.
Yeah, I tell you, I'm going to publish a report on you guys. We call them profiles down here, and I'll just wait until after you report third quarter results, and so to include those in there.
Love it.
perfect.
Sounds
Yeah,
great.
Yeah, we have 3 model portfolios. I don't know if you've seen my newsletter. I'll send you a copy of the last one, and I'm going to publish another one on next Tuesday. We have 3 model portfolios, a Sweet 16. Then there's a small cap where you guys would fit into that, and then there's a high yield. The yield on these companies, and I mean really high quality companies, it's amazing how many have double-digit dividend yield. It's great. Amazing. And it looks like you guys are going to get close to that pretty soon. So that's good. Anyway, I guess we'll leave it at that. And I'll be talking to Jessica, and maybe we can get you guys down here for a luncheon in late November or December or something.
I love it. You
Yeah,
set it
actually,
up and we'll be
we've got,
there.
yeah, Hemisphere is hosting a luncheon on November the 28th. Yeah, that's right. So, and in play, we'll be down here one of these days. All right, guys. Well, thanks a lot, man. This was very good, very exciting. I love your intensity, and I think we are living in very unique times, and this industry is going to show how much money can be made in the oil and gas sector. It's a very profitable business when it's like this, and I don't see any near-term end to these high energy prices anytime soon. In fact, I think if we have a cold winter, we could see a massive spike in natural gas prices, and there's a space heating fuel shortage across the board. It looks like to me, not just in Europe, but in here in the US as well. So we live in interesting times. So Sabrina, why don't you end it there? We'll trim this up a little bit, and we will send out a link to the replay later this afternoon.
Sounds good. Thanks, Dan.
everyone.
Okay, thank you. Bye-bye.
Take care.
Alrighty.
Bye.